Millions of Canadians are earning less interest than they should be right now, today, simply because they picked the wrong account. Rates have shifted, the landscape has changed, and the safe choice from 2 years ago might actually be costing you money in 2026. So GIC or HISA? Let's settle this. In this video, we're breaking down everything you need to know to make the right call between a GIC and a high-interest savings account in 2026. We'll compare current rates, talk about liquidity, which is the factor most people completely overlook, and then walk through the tax angle inside a TFSA, RRSP, and FHSA. By the end, you'll know exactly which option fits your specific situation. No guessing. Let's get into it. Let's start with the basics, because these two products are more different than most people realize. A GIC, a guaranteed investment certificate, is essentially a contract. You hand your money to a bank or credit union for a fixed term. Could be 30 days, could be 5 years. In exchange, they guarantee you a fixed interest rate. The trade-off? In most cases, that money is locked in. You can't touch it until the term ends without facing a penalty, or in some cases, you simply can't access it at all. A high-interest savings account works differently. It's still a deposit account, still pays interest, but your money stays liquid. You can move it in and out whenever you want. The catch is that the rate can change at any time. The bank can drop it tomorrow if they feel like it. Now here's where it gets interesting in 2026. After the Bank of Canada's rate-cutting cycle that started in 2024, we've seen deposit rates compress significantly from their 2023 peaks. Back in late 2023, you could find one-year GICs pushing 5.5% and some HISAs briefly touching 4.5% through promotional offers. Fast forward to today, the best non-promotional HISA rates from digital banks and credit unions are sitting in the 3.0% to 3.5% range. Meanwhile, one-year GIC rates from the same institutions are offering roughly 3.5% to 4.0%, with some 2-year terms stretching close to 4.25% if you shop around. That spread between a competitive HISA and a one-year GIC is roughly 50 to 75 basis points right now. That might sound small, but on $50,000 in cash savings, that's a difference of $250 to $375 per year. Not life-changing, but not nothing either. Okay, so GICs pay more. Case closed, right? Not so fast. Because the real question isn't just which pays more. It's which pays more for what I'm actually using this money for. And that's where liquidity becomes the deciding factor. Think about what your cash is actually doing. If it's your emergency fund, the 3 to 6 months of living expenses that you hope to never touch, but absolutely need available if things go sideways. Locking that into a non-redeemable GIC is a genuinely bad idea. You don't want to be calling your bank in a panic because you lost your job, only to find out your $20,000 is locked until March and you'll forfeit 3 months of interest to break it early. Now, some GICs are cashable or redeemable, meaning you can get your money out before the term ends, typically after a minimum holding period of 30 to 90 days. The rates on these are usually lower than non-redeemable GICs, often landing closer to HISA territory anyway. So the liquidity advantage there starts to close. On the other hand, if you're saving for something specific with a known timeline, say, a home purchase closing in exactly 12 months, or a tax installment due in 6 months, or you're just parking a year-end bonus you won't need until next December, a locked GIC starts making a lot more sense. You know the date. You don't need the flexibility. Lock it in, take the higher rate, move on. A good rule of thumb: your emergency fund lives in a HISA. Your goal-based savings with a defined timeline live in a GIC. Here's where this conversation gets really interesting, and where most basic comparisons completely drop the ball. Because where you hold a GIC or HISA matters just as much as which one you pick. Let's run through the accounts. Inside a TFSA, interest income is completely tax-free. Doesn't matter if it's a GIC or a HISA, the CRA gets nothing. Given the 2026 TFSA contribution limit bringing the cumulative total to $109,000 for those who've been eligible since 2009, there's real room to shelter meaningful cash here. If you're holding cash savings inside a TFSA, prioritize putting the higher rate option, usually the GIC, here first, since you're maximizing after-tax return on your best rate. Inside an RRSP, interest income is tax-deferred. You're not paying tax now, but you will when you withdraw. GICs inside an RRSP make sense if you're in accumulation mode, and won't need the money for years. Just be aware that GIC interest earned inside an RRSP eventually gets taxed as ordinary income on withdrawal, unlike capital gains treatment you'd get on equities. The FHSA, the First Home Savings Account, is the newest player here. Contributions are tax-deductible like an RRSP, growth is tax-free like a TFSA, and withdrawals for a qualifying home purchase are completely tax-free. If you're a first-time buyer saving for a down payment with a clear 1 to 3 year horizon, parking a GIC inside your FHSA is arguably the single best use of a GIC in the entire Canadian financial system right now. Then there's non-registered accounts. This is where it stings. Interest income from both HISAs and GICs is taxed as ordinary income at your marginal rate. For someone in a 43% marginal bracket in Ontario, earning 3.75% on a GIC effectively becomes about 2.1% after tax. At that point, the liquidity premium of a HISA starts looking a lot more reasonable. In a non-registered account, you also need to report accrued GIC interest annually to the CRA, even if you haven't received it yet. That's a cash flow consideration worth knowing. So let's bring this together with a simple framework you can actually apply. If your cash is an emergency fund, HISA, full stop, liquidity wins. If your cash has a defined timeline of 1 to 5 years and you won't need it before then, shop for the best GIC rate, lock it in, and stop checking rates every week. If you're a first-time home buyer with FHSA room, use it and put a GIC inside it. You're getting a tax deduction going in and zero tax coming out. That's hard to beat. If your savings are in a non-registered account and you're in a high tax bracket, run the after-tax math before automatically assuming the GIC's higher headline rate wins. Sometimes the flexibility of a HISA plus the ability to shift strategy as rates move actually produces a better outcome net of tax. And one more thing, don't just default to the big 6 banks. EQ Bank, Oaken Financial, Achieva Financial, and various credit unions consistently offer GIC and HISA rates that are meaningfully higher than what you'll find at TD or RBC. CDIC protection covers deposits up to $100,000 per category, so there's no reason to leave yield on the table out of habit. Here's what it comes down to. GICs pay more, right now, roughly 50 to 75 basis points more than the best HISAs. But that premium only makes sense when you don't need the liquidity and you're holding in a tax-efficient account. Match the product to the purpose. Emergency fund stays liquid in a HISA. Goal-based savings with a fixed date gets locked into a GIC. And wherever possible, shelter that interest income inside your TFSA or FHSA so the CRA doesn't take a cut. The worst move? Defaulting to whatever your main bank offers without shopping around. A few minutes on a rate comparison site could easily mean hundreds of extra dollars per year, completely